The following are the summarized balance sheets of A Limited and B Limited as on 31st March 20x1. Figures are in thousands. Equity shares of 100 each. So 100 each. That means 20,000 shares are there here and 10,000 shares are here. No preference shares are there. Reserves, debentures, loan from bank, overdraft, and the trade payables. Assets are given. Tangible assets or the fixed assets, investments, trade receivables, cash at bank, accumulated loss is there. Okay. So P&L debit balance is there of 800. Accumulated loss is nothing but the profit and loss debit balance. So you have a loss making company over here. Fine. What is the information? They are saying B Limited has acquired the business of A Limited. B Limited. B Limited is the purchasing company. A Limited is the selling company. Okay. So first they have given you the balance sheet of selling company and then they have given you the balance sheet of purchasing company. Be careful. Most of the times the first balance sheet would be for purchasing and then selling, but here the order is reversed. Okay. Banks agreed to waive off the loan of 60,000 to of B Limited. And then they say B Limited will reduce its shares to 10 per share and then consolidate 10 such shares into one share. Okay. So a little bit of internal reconstruction is given. Then they are saying shareholders of A will be given one share in exchange of every share. That means the share exchange ratio is 1 is to 1. Okay, share exchange ratio is 1 is to 1. And as you can see here, first the share will become of 10 rupees and then the share will become of 100 rupees. So 1 is to 1 is there and the shares will be issued at 100 rupees. Trade payables of B include rupees 100,000 payable to A Limited. So that's a mutual obligation. They are saying pass necessary entries in books of B Limited. B Limited is the purchasing company and prepare the balance sheet after the merger. There is a slight insertion to be made in the question. So after this, just add follow. It's not printed in the question, but write down follow pulling of interest method. Follow pulling of interest method. If you see the solution given by ICAI, they have followed the pulling of interest method. But to be very honest, I'll be very honest over here. You cannot follow pulling of interest method over here. Pulling of interest method is followed when it is amalgamation in the nature of merger. Okay, this is not an amalgamation at all. Amalgamation means selling companies will merge and a new entity will be formed. This is actually absorption. Okay, this is not amalgamation. But then I will solve the question the way it has been solved by the institute in its study module. So I'm just making an insertion. If this insertion is made, then the question will be, the solution will be the way it is provided in your study module. Otherwise, technically, you should follow the purchase method and account for it accordingly. You may say, what difference will it make if I consider it to be purchase method or pulling of interest method? See, it makes a lot of difference. In pulling of interest method, I will take over all the reserves of the selling company, which I never do in purchase method. In pulling of interest method, whatever is the difference, I will adjust in the reserves, while purchase method will give rise to goodwill or capital reserve. Okay, so just make this small insertion and everything is fine. We'll say follow pulling of interest method. The first thing, of course, will be to work out the purchase consideration. So let's get the purchase consideration. Yes, let's do it. Determination of purchase consideration. The figures will be in thousands. Only equity shareholders are there this time. So we will show what we are giving to the equity shareholder. A Limited is the selling company. So just check with A Limited's balance sheet. 20,000 shares are there, right? And as we understood, as per information 3, share exchange ratio is 1:1 and shares will be issued at 100 rupees each. So that is sufficient information to get the purchase consideration. 20,000 shares are there. I'll multiply that by 1. That is 20,000 shares of B Limited will be issued at 100 rupees. Purchase consideration is 2,000. The question is to prepare the journal. Okay, supposed to prepare the journal. So we say journal of B Limited. They are saying banks have agreed to waive off the loan of 60,000. So our loan will reduce by 60,000. So bank loan account debit 60 to reconstruction account. You can even open capital reduction account, but reconstruction account is a better choice of words. To reconstruction account 60. Narration, I'm leaving it to you. We are reducing our shares to 10 rupees per share. Okay. Right now it is of 100 rupees. So we say equity share capital rupees 100 account debit 1,000 to equity share capital. We are making it now of 10 rupees. 10,000 shares are there and now they have become of 10 rupees. 100 to reconstruction account or capital reduction account 900. And now we are consolidating 10 such shares and making it of 100 rupees. So from the face value of 10, we will return back to the face value of 100. Equity share capital 10 is there right now. 100. I will consolidate the shares and make it of 100 rupees now. So to equity share capital rupees 100 account 100. So now you are having 1,000 shares. Understand this. You now have 1,000 shares carrying a face value of 100. This is what is happening in these accounting entries. So if you get a good perspective of the accounting entries, and yes, in case if you're still writing, you can pause the video here. First of all, our banks are agreeing not to get 60,000. So this is a benefit for us. So we transfer it to reconstruction. Loans have a credit balance. I have to reduce the loans, so I debit it. Then they are saying that your face value is 100, but you are saying that now it will be only 10. Okay. So 10,000 shares were there and 10. So 100. So 900 goes away to reconstruction. So if you see 60 over here and 900 here, so you have total 960 in your reconstruction account. The third accounting entry is only a transfer entry. From 10, I am making it 100, but the number of shares have now become only 1,000 shares. This balance in reconstruction will be now utilized. You can see there is a accumulated loss of 800. I will write off that loss now. I have sufficient money to do that. Reconstruction account debit 960. Write off the loss to profit and loss account 800. Excess amount, I let it go to capital reserve. To capital reserve account 160. So before the acquisition, there is a small reconstruction, internal reconstruction that we are doing. So we give effect for the same. Pause the video at appropriate places so that you can complete your journal till here. Yes, now we will record the accounting entries for the scheme of amalgamation. I'm taking over the business of this company, A Limited. Right? Business purchase account debit 2000 to liquidator of A Limited 2000. I will incorporate now the assets and the liabilities. We will follow pulling of interest method as we had discussed. Everything will be recorded at their book values. I will take over every asset. I will take over every liability. I will take over even the reserves. And then I will balance the accounting entry. And whatever difference is there, it will be adjusted with the reserves. So fixed assets account debit. Check with your balance sheet. Fixed assets account debit 2700. Right here it is 2700. Investments account debit 700. Trade receivables account debit 400. Cash at bank account debit 250. Leave a line for the balancing. Okay. To debentures account, incorporate the liabilities. Bank loans account, to trade payables account, to business purchase account. Balance the accounting entry. Whatever difference is there, it should be debited to the reserves or credited to the reserves, right? We get reserves of 1000, which is there exactly the way it is there in the balance sheet. So basically, there is no reserve to be credited or debited. We are getting the exact amount. Let's settle the liquidator. Liquidator of A Limited account debit 2000. We are issuing equity shares, so to equity share capital account 2000. And yes, that mutual obligation. Trade payable account debit 100 to trade receivable account 100. So if anything is pending here, complete it. Accounting entry 5 and 6, anything pending? Pause the video here. Anything here? 7 and 8. Time to prepare the balance sheet. Balance sheet of B Limited and reduced, right? 31st March 20x1. Figures are in thousands. Equity and liabilities. Shareholders funds. Share capital. Reserves. Note 1, note 2. Right. Non-current liabilities. 10% debentures. 500. Bank loans. 640. Current liabilities. Trade payables. Bank overdraft. Total, we leave it blank. Assets, first head, non-current assets. Property, plant, and equipment. Line by line addition. Investments. Current assets. Trade receivables. Right, line by line addition, 400, 150. We have eliminated 100, 450. Cash and cash equivalents, line by line addition, 250. Total. So the asset side total is 4950. Obviously, that will also be the equity and liabilities total. But yeah, we are getting that 4950. See notes. We ought to prepare the notes now. Note 1 is for share capital. Only equity share capital is there this time. So equity share capital, right? We will prepare a note for the equity share capital. We have only one share. We have only one share, but we have issued another 20,000 shares. So total 21,000 shares, equity shares actually, at the rate rupees 100, right? So 21,000 equity shares are there. 2,100. Go to your balance sheet, post against note 1, 2,100. The final note, reserves. We have capital reserve, right? We have capital reserve 160. Others, the one that we took over, and our own. So 1160. Double 160. So that's your equity and liabilities. You can pause the video here if this is what is pending for you. These are your assets. You can pause the video here if this is what is pending for you. And finally, these are the notes if that's what is pending for you. That's the last piece of the solution.